Long before screens flickered with prices and algorithms whispered trades across oceans, money was not a thing you could hold so much as a problem. Humans were trying to solve and to understand its origin. You have to imagine a world where value existed, but money did not. A world of farmers, hunters, craftsmen, and small communities bound together by trust, memory, and obligation, rather than by coins or notes, where exchange was personal and economic. Life was inseparable from social life, because when a herder traded meat for grain or a potter exchanged jars for tools, they were not participating in a neutral market, but in a web of relationships that remembered favors, debts, and reputations far longer than any ledger could. The popular myth tells us that money arose cleanly out of barter, that people once wandered around with sacks of goods, trying to find someone who wanted exactly what they had and offered exactly what they needed, and that money appeared as a convenient shortcut. But history is far messier and more revealing than that, because pure barter economies almost never existed at scale, and what we see instead are credit systems, gift economies, and communal accounting, where value was tracked in the mind long before it was stamped in metal. In ancient Mesopotamia, thousands of years before the first coins, temples and palaces kept clay tablets recording who owed what to whom, denominated in units of barley or silver that were rarely exchanged physically, meaning that money first existed as an abstract measure, a unit of account long before it became a medium of exchange. And this inversion is crucial because it tells us that money was born not from trade between strangers, but from systems of debt power and administration. When silver shekels were mentioned, they were often imaginary weights, not jingling objects, and the real economy ran on trust, backed by authority, enforced by social hierarchy, and when necessary, violence. As societies grew larger and trade expanded beyond kin and village, the limits of memory and trust became painfully clear, because you cannot rely on reputation alone when dealing with strangers across mountains or seas. And it is here that we begin to see the slow crystallization of money into physical form, not as a convenience for peasants, but as a technology of states. Coinage, which emerged independently in places like Lydia around the 7th century BCE, was not invented by merchants seeking efficiency, but by rulers seeking control, because a stamped piece of metal bearing the symbol of a king was a promise backed by authority, a way to pay soldiers, collect taxes, and project power across territory. These coins did not merely facilitate trade, they standardized it, imposed a unit of account, and tied economic life to political sovereignty. And once armies were paid in coins, markets followed the armies, because where soldiers spent their wages, merchants gathered, and where merchants gathered, prices converged, and money began to feel inevitable, natural, even eternal. Yet even in the age of gold and silver, money remained an unstable creature, constantly torn between its physical substance and its social meaning, because metal alone does not make money trustworthy. What matters is the shared belief that it will be accepted tomorrow, and this belief has always been fragile. Empires debased coins to fund wars, shaving silver content while keeping face values the same. And each debasement was a quiet tax on trust, a reminder that money is as much a political instrument as an economic one. When Rome diluted its denarius over centuries, it was not merely mismanaging currency, it was revealing the hidden cost of empire. And when confidence finally cracked, prices soared, trade retreated into localism, and money itself became suspect. History repeats this lesson relentlessly. Money survives, not because it is made of something valuable, but because people believe in the system that stands behind it. The medieval world carried this tension forward, layering new institutions onto old instincts, as gold and silver coins circulated alongside bills of exchange, promissory notes, and early banking networks that allowed merchants to move value across borders without moving metal. And here again, abstraction preceded physical settlement. A Florentine banker could settle accounts across Europe with ink and reputation, and families like the Medici did not simply move money. They manufactured trust, turning private credit into public confidence, and quietly teaching the world that money could be created through lending, not mined from the earth. This was a profound shift, because once money could be created by extending credit, the supply of money was no longer bound to physical scarcity, and economic growth became entangled with debt expansion and cycles of boom and bust. When trust held, the system flourished. When it broke, panic followed, and the familiar rhythm of financial history began to beat more loudly. By the time paper money emerged in China, and later in Europe, the transformation was complete, because paper stripped money of any remaining illusion that value resided in substance rather than belief. A banknote was an explicit confession that money was a promise, a claim on value rather than value itself, and states quickly realized both the power and the danger of this invention. Paper made it easier to finance wars, infrastructure, and empire, but it also made it easier to overreach, and each hyperinflation from revolutionary France to Weimar Germany stands as a monument to the moment when belief evaporated faster than ink could dry. Still, paper money endured, not because it was flawless, but because it was adaptable. And as central banks emerged to manage currencies, money became increasingly abstract, increasingly centralized, and increasingly distant from everyday experience, until by the late 20th century, most money existed only as digits in bank databases, moving at the speed of electrons rather than horses or ships. It is against this long backdrop of abstraction, trust power, and crisis that Bitcoin appears not as an alien rupture, but as the latest chapter in an ancient story. Because when Satoshi Nakamoto released the Bitcoin white paper in 2008, it was in the shadow of a financial crisis that had once again exposed the fragility of trust in centralized institutions, banks that created money through leverage states, that socialized losses, and a public that paid the price through unemployment and austerity. Bitcoin did not propose a return to barter, nor did it simply invent a new digital token. It attempted to rewrite the trust architecture of money itself, replacing institutional authority with cryptographic proof, central control with decentralized consensus, and human discretion with algorithmic rules. Like coinage in ancient Lydia, Bitcoin was born from a crisis of confidence, and like paper money. Before it, it asked society to believe in something intangible. Except this time, the promise was not backed by a king or a state, but by mathematics code and a distributed network of strangers agreeing on a shared ledger. Whether Bitcoin ultimately fulfills its ambitions or fades into a historical footnote remains an open question. But its existence forces us to confront truths that history has been whispering for millennia: that money is not a thing, but a relationship, not a substance, but a system, and that every monetary order rests on a foundation of belief that can shift, fracture, or be reinvented when circumstances demand it. And as we trace the path from ancient debt tablets to digital wallets, we begin to see that the story of money is really the story of how humans coordinate trust at scale, how they remember obligations, enforce promises, and imagine value together. And it is precisely at this fragile intersection of belief and technology that the modern world now stands, staring at a form of money that exists everywhere and nowhere at once, asking whether this time, unlike so many before, the system can endure without a throne, a temple, or a central bank. Because the real question Bitcoin poses is not whether code can replace cash, but whether trust itself can be redesigned in a world that no longer agrees on who should be trusted to decide what money is and who is allowed to create it, when the old guardians of value are no longer believed to be neutral arbiters, but interested players in a system that increasingly feels detached from the lives of those who depend on it, and that growing unease is the emotional soil from which this new monetary experiment has emerged, carrying with it echoes of every past transformation, every collapse, and every rebirth of money across history. As we now move deeper into an era where value identity and sovereignty themselves are being renegotiated through code networks and collective belief, and it is here at this threshold that the ancient question returns in a modern form, not what money is made of, but who we trust to define it, and under what rules that trust will survive when the next crisis inevitably arrives and forces society to choose once again between systems imposed from above and systems that emerge from below. Because history suggests that the answer will shape not just markets, but the very structure of power in the decades to come, as money continues its long journey from tangible exchange to pure abstraction, and finally into a realm where value exists only, insofar as millions of people agree silently and continuously that it does. And that agreement now rests on foundations more fragile and more revolutionary than at any other moment since humans first began to measure obligation and worth. And in the next movement of this story, we must step inside the deeper consequences of that shift and examine how this redefinition of trust collides with human psychology, speculation cycles of greed and fear, and the repeating patterns that have governed every monetary revolution before it could fully stabilize or collapse under the weight of its own contradictions and expectations. Examine how this redefinition of trust collides with human psychology, speculation cycles of greed and fear, and the repeating patterns that have governed every monetary revolution before it could fully stabilize or collapse under the weight of its own contradictions and expectations. Because no system of money has ever failed purely for technical reasons, and no system has ever survived purely because it was efficient, as money lives or dies inside the human mind, where hope, anxiety, envy, and the desire for certainty wrestle constantly with reality. When Bitcoin began to circulate beyond cryptographers and cypherpunks, it did not enter a vacuum of rational actors calmly evaluating code. It entered the oldest marketplace in history, the one inside the human psyche, where stories matter more than spreadsheets, and where future dreams are often priced far higher than present facts. The early adopters spoke in the language of liberation, censorship resistance, and sound money, echoing centuries-old frustrations with debased currencies and unaccountable authorities. And these narratives were powerful not because they were entirely new, but because they resonated with historical memory, even among those who had never read a monetary treatise, because somewhere beneath the surface, people understood that money has always been a bargain with power, and Bitcoin promised, at least in theory, to remove the need to bargain at all. But history warns us that every attempt to escape power structures creates new ones, often invisible at first. And as Bitcoin's price rose, the idealism of its design collided with the realities of speculation. Wealth concentration and herd behavior patterns, as old as the Dutch tulip markets and the South Sea bubble. Early miners and believers accumulated vast holdings, exchanges became new intermediaries, and leverage crept back into a system that had promised to eliminate it, because humans, when given a new form of money, almost immediately reinvent the familiar behaviors that money enables. Booms followed narratives, busts followed disillusionment, and each cycle burned away weaker hands, while reinforcing the conviction of those who remained, mirroring the emotional arc of gold rushes, railway manias, and dot-com euphoria. None of this invalidates the technology, but it situates it firmly within the historical truth that financial innovation does not abolish human nature. It amplifies it. At the same time, states did not stand still, because they never have, when their monetary authority is questioned. And just as ancient rulers stamped their faces onto coins, modern governments began to regulate tax surveil, and in some cases, attempt to co-opt digital currencies, while central banks explored their own digital forms of money, not to decentralize power, but to preserve it in a new technological wrapper. This dynamic is deeply familiar to the historian's eye, because every major monetary shift from metallic standards to paper to fiat has involved a struggle between private innovation and public authority, between those who create new monetary tools and those who seek to control them. Bitcoin, for all its novelty, is therefore not an end-of-history moment, but a continuation of an ancient contest, one that asks whether trust can truly be distributed without eventually recentralizing around convenience regulation or force. What makes this moment uniquely fragile is that money has now become almost entirely abstract, detached from physical constraint, while simultaneously becoming emotionally charged in an era of inequality, debt saturation, and declining institutional credibility. When money was heavy, scarce, and slow, its failures unfolded over generations. When money is digital, liquid, and global, belief can collapse in minutes. A rumor, a regulatory announcement, or a line of code can erase billions in perceived value overnight, reminding us that abstraction accelerates not just growth, but panic. This is not a flaw of Bitcoin alone, but a condition of modern finance itself, where speed magnifies both confidence and fear, and where the margin for error narrows as systems grow more complex and interconnected. And yet, despite these dangers, history also teaches that monetary experiments, even failed ones, leave permanent marks because they expand the imagination of what money can be. Double-entry bookkeeping did not end crises, but it transformed commerce. Central banking did not prevent panics, but it reshaped states. Paper money did not abolish scarcity, but it enabled modern economies to exist at scale. In this sense, Bitcoin's most enduring legacy may not be its price, or even its survival as a dominant currency, but the fact that it has reopened a question many believed was settled, forcing societies to debate who should issue money, under what rules, and with what limits. Once such questions are asked aloud, they cannot be unasked, and history rarely moves backward in silence. The deeper lesson, then, is not that money evolves from barter to coin to code in a neat line of progress, but that money continually oscillates between trust and control, freedom and stability, innovation and discipline. Each generation inherits a monetary system shaped by the fears and ambitions of the last tests, its limits through crisis and speculation, and then either reforms it or replaces it with something new that promises relief while planting the seeds of future tension. Bitcoin stands precisely at that inflection point, admired by some as a bulwark against inflationary excess, dismissed by others as a speculative mirage, and used by many simply as another asset in a world already drowning in financial instruments. And this ambiguity is not a weakness, but a historical signal, because truly transformative monetary technologies are always misunderstood in their own time. As we step back and view the full arc from ancient debt ledgers to decentralized blockchains, a pattern emerges with unsettling clarity that money has never been about efficiency alone, but about legitimacy, about whose promises are believed and whose are not, and about how societies encode power into everyday exchange. Barter did not disappear because it was inefficient. It disappeared because it could not scale trust. Gold did not reign because it was shiny. It reigned because it constrained rulers until rulers learned to escape its limits. Fiat money did not dominate because it was honest. It dominated because it was flexible. Bitcoin, likewise, will not succeed or fail because of cryptography alone, but because of whether enough people for long enough believe that its rules are fairer, more predictable, or more honest than the alternatives they already endure. And so the origin of money is not truly behind us. It is repeating itself in real time because every new form of money is born the same way the first ones were, through a crisis of trust and a leap of collective imagination. The shells, the silver, the paper, the digits, and the hashes are merely costumes worn by a deeper social agreement, one that says value exists because we agree to treat it as such tomorrow. If there is a warning embedded in this long story, it is that no monetary system, no matter how elegant, can permanently escape the moral and political questions that surround it. And if there is a hope, it is that, by understanding this history, investors, citizens, and policymakers alike can recognize the early signs of excess, resist the oldest temptations of blind faith and blind fear, and approach new forms of money not as saviors or enemies, but as experiments whose outcomes will be shaped as much by human behavior as by design.